hawkish tone from Adrian Orr. I mean, he had to make this move because he is playing catch-up, especially since you're expecting the Fed to move 75 at the next meeting.
That's correct, and I think the expectation of a dovish tilt is absolutely misplaced. I think what we're seeing here is the Fed has been relatively early and aggressive. 75 basis point last meeting, JPMorgan forecasts have 75 basis points in September. What we have to do is really take a step back and recognize that in every developed market economy in the world today, you still have negative real rates. You still have expansionary rates at play, in which case we still have multiple rate hikes again in many markets. U.S. was early, which led to significant dollar strength, which was positive for the U.S. economy. Other markets are now forced to play catch-up. We've seen that out of the U.K., ECB. We're now seeing it in New Zealand.
The thing is, are you expecting the RBNZ to move another 50? And the question for every central bank governor right now is the neutral rate.
And it's a great question because the underlying definition of the neutral rate is an offset of the rate relative to unemployment. And as we look at the unemployment rate in multiple markets around the world, it is extremely low. But we are also seeing a very significant issue of a lack of labor mobility, which is driving significant upward pressure in wages. And so it's a very complex picture for central banks in a lot of markets around the world. The critical element of the second half of the conversation is really the second half of this year. JPMorgan forecasts we had 9.7% inflation in the first half. We're forecasting only 4.7% in the second half, off of a significant decline in both agricultural and energy prices that we've already started to see. So again, very complex picture for central banks. The backstop to this, though, however, is still negative real rates in all developed markets, which lead to significant pressure on rates to continue to move up.
That's interesting, James. If you're expecting inflation pressures to basically have in the second half, what does it mean for sector allocation then? Do I move away from energy, commodities, all these things that were really kind of fueling a lot of where we see more of the gains in the first half as well? What does it mean for now asset allocation?
It's a great question, and it really depends on the time horizon that an investor is bringing to the table. From a short-term perspective, we've already seen a bottoming out of growth stocks. We've seen tech stocks here in Asia up 8% off their lows, with the potential for some short-term momentum off the back of the rate cycle that we're currently seeing. I think the difficulty that we have, particularly in the Asia tech space, that's preventing us from getting bullish at JPMorgan, is the fact that you still have company management teams that are still talking relatively optimistic stories. You're still seeing significant inventory builds across the Asia tech space, which is generally a very difficult environment for tech shares to outperform. So from a short-term perspective, you can see this continued ongoing rotation into tech, out of energy and commodities. I don't think that has significant legs as we look to the early half of next year, however.
Yeah, and then we were looking at the Bank of America manager survey, and it seems like positioning, it's still bearish, but at least we're not kind of close to that capitulation as they mentioned in the last survey. And I have to wonder, does this mean to you that are we seeing early signs of an early cycle recovery, James, then? Or is this just another pause in this bear market rally?
It's a great question, and one of the significant conversations that we're having with investors right now is pairing the fundamentals with the underlying positioning data, and it's absolutely critical. If you look at the China market year to date, you saw significant downward pressure through April. Our surveys in April indicated that investors were the most underweight China that they've been in the history of our survey. You then saw that market rebound from April through mid-June. On our surveys, you had squared positions off in China by mid-June, and the market started to lose momentum. So that underlying positioning data is absolutely critical because ultimately you need buyers and sellers to move the market, and then they will use the fundamental information as catalysts for those trades.
We saw your calls, positive returns from the USD, but the USD is close to peaking if it hasn't peaked already, right?
We think it has, and one of the reasons why we're positive emerging markets globally is exactly that. EM markets have a very hard time getting out of their own way in a strong dollar environment. As we opened up the segment, the Fed was early and aggressive. We're now seeing other central banks start to play catch-up, which starts to put a cap on the US dollar.
So in terms of pairings for USD and Asian currencies, what are the best pairings out there?
So globally, we're positive on financials. We're still negative on staples and healthcare and real estate from a global sector allocation perspective. Within Asia, we still see room for outperformance in some of the Southeast Asian markets. It is interesting to note that the two worst performing markets in the world year to date are Korea and China. Again, really ultimately in Korea, a call on the tech space. We see a short-term trade there, but not necessarily a long-term productive environment for investors.
what needs to happen for China to see some sort of meaningful reversal then? I wonder, do I need to wait for the credit impulse to bottom out first? I mean, more policy signals in the property market? What's still needed there, you think?
I think you raised some very significant issues. One, the credit data coming out of China has been significantly weak relative to expectations, really across the board, both private sector as well as corporate. It's also, I think, critical to recognize that from a local government perspective, we saw this very significant increase in bond issuance from local governments. That will naturally start to fade, which gives us significantly less cash to put into markets, particularly from an infrastructure investment perspective. And so it's unclear at this stage where the incremental fiscal stimulus will come from and how that will be funded. And we lack credit demand, particularly in the private sector space. And so that lack of clarity really puts a cap on the China market from the short term.